Let's be honest. Assessable profit and total profit sound like twins that enjoying confusing students. 1 minute you are adding back expenses, next minute you are subtracting losses. Before you know it, your calculation looks like a WhatsApp chat. But here is the secret. This topic is actually one of the fastest ways to score easy maths in taxation and advanced taxation once you know the simple secrets step by step. And in this video, I'm going to show you exactly how. Keep watching. Total profit is arrived at after the deduction of loss relief and the granting of capital allowance from adjusted profit. After loss relief has been deducted and capital allowance have been granted from adjusted profit, we arrive at the total profit. I will advise you watch my earlier videos on adjusted profit and capital allowances. So, format for the computation of total profit. Total ascertainment. Let me say XYZ Limited. Ascertainment of total profit. So you start with the profit as per account, profit as per account. Remember, I gave you two formats or two methods of computing the adjusted profit in my earlier videos. So you add non-allowable expenses, add non-allowable expenses reported in account. Those expenses that are not allowable, that have been included in the statement of profit or loss. So, and that may include depreciation. Depreciation is not allowable. Loss from disposal. Loss from disposal of PPE. Loss from disposal of PPE, capital expenditure or capital expenditure are not allowable. Then donations. Donations to non-approved body. Donations to unapproved body or bodies. Then we also have general allowance for doubtful debts. General allowance for doubtful debts. Remember, I've told you specific is allowed. Then we also have diminution in value of investment. Diminution in value of investment. Then we may also have then taxable income not reported. Taxable, or let me add this one first. So you have the sum of this, you add it to what you have at the top, which is profit as per account. Then you now add taxable income not reported in account. Those income that are taxable, which have not formed part of the profit reported in the account. Then after this, you deduct non-taxable income reported in account, less non-taxable income reported. in account. Those incomes that are not taxable, that have already formed part of the profit or loss, like profit from sale of PPE, profit from sale of property, plant, and equipment. Then we also have profit on export sales, profit on export sale. Then you may equally have interest on agri or export loans. Interest on agri or export loan. Then allowable expenses not reported. Allowable expenses not reported in account. Those expenses that are allowable and which have not been charged in the statement of profit or loss. It means if you have allowable expenses that have already been used in the statement of profit or loss, when using this method, you don't touch them at all. You should not use them at all. If expenses are allowable, and those expenses that are allowable, if they have been recorded in the statement of profit or loss, they will not be used in the computation of adjusted or total profit or assessable profit. Please bear this in mind. So after all these adjustments, you arrive at the adjusted profit or assessable profit. Adjusted profit or assessable profit. After the adjusted profit or assessable profit, in case you have a loss for prior year, unclaimed loss, on relief loss in prior year, you are going to make them available for release. So we have loss brought forward, that is from previous accounting period. Then loss relief. That loss, we want to relieve it. In case you have unrelieved loss, it will be carried forward. Unrelieved loss carried forward, if any. That is where the loss is greater than the assessable profit or adjusted profit. But if the loss is not greater, then you have the profits, the mini profits now is what will be you are going to use. You add balancing charge. Add balancing charge. You add balancing charge. After adding balancing charge, you now deduct capital allowance. Capital allowance, let me say for the year. Capital allowance brought forward from prior year. Unclaimed capital allowance in prior accounting period or in prior tax year. So that capital allowance, you are going to bring it forward. That is how we got the capital allowance brought forward. So if you add it, then you are going to claim your capital allowance. Capital allowance claimed. The amount you claim from it. Then if you have unclaimed capital allowance, it will be carried forward. Unclaimed capital allowance carried forward. Unclaimed capital allowance will be carried forward to the next period. Then if you deduct the capital allowance claimed from the profit you have here, you have the total profit. Total profit. On your total profit, you apply your relevant tax rate. I've told you the rate to use depends on the size of the company, whether a small company, whether a medium-sized company, or a large company. For a small company is a company with turnover less than or equal to 25 million. And for a small company, the tax rate is 0%. For medium-sized company, it's a company with turnover of over 25 million but less than 100 million. And for a medium-sized company, the tax rate is 20%. That means if the examiner want to distinguish the type of company, they will give you the turnover. And for a large company, is a company with turnover of 100 million and above. And the tax rate for a large company is 30%. I've told you for small companies, 0%. For medium-sized companies, 20%. For large companies, 30%. So the rates to use depends on the size of the company in question. So for this purpose, examiner may always give you the turnover or the revenue, and that will enable you to know the size of the company. But where the turnover or revenue is not given, so you assume the company is a large company, and you may go ahead and use 30%. So for the purpose of this question, after the company income tax have been computed using the appropriate tax rate, then you may also include the tertiary education tax. But the tertiary education tax will lapse in December 2025. So it means effective from January 2026, there will be nothing like tertiary education tax. The tertiary education tax will be replaced with development levy, and the rate will now be 4% from 2026 January upwards. So it means the year in the question you are given is what will determine the rate to use. So if the year of assessment, your year of assessment is 2025-2024, so you are still expected to use the tertiary education tax. Even if in 2026 year of assessment, if January 2026 is not part of that 2026 year of assessment, tertiary education tax will still be used in your solution. So before the development level will be used, then the year of assessment, January 2026, have to form part of the year of assessment before you can use development levy of 4%. And these are what some of us did not know, and that is why some thought the video I had on my channel, which I have recorded some years ago, they thought it's no longer relevant. The videos are still relevant. What determines the changes, like the investment allowance I've said from September 2023, you will not need to include the investment allowance in your computation of plant and machinery, capital allowance on plant and machinery. That is if the date of acquisition is from September 2023 to date. But if the date of acquisition is prior to that September 2023, you will still need to include the investment allowance. So you should always watch out for all this, because examiner might, in fact, even in the same question, especially where you are expected to compute capital allowance for more than 1 year, it is possible you might have qualified plant and machinery in 1 year that will be eligible for investment allowance. And in another year, it will not be eligible for investment allowance. What determines that is the time of acquisition. You have to check the time of acquisition whether it will be eligible for investment allowance or not. Please always watch out for all this. Having explained all this, so we want to take a question as work example. Keep watching. This question is obtained from ICCA November 2025. Taxation question number 2. Zarin Limited commenced business on November 1st, 2019. It has its registered office in Ibadan. The company prepares its accounts to December 31st every year. The audited financial statements for the year ended December 31st, 2023 reveal the following. Amount is in 1,000 naira. Gross profit 68 million. Expenses comprises salaries of 16.2 million, repairs and maintenance of 13 million, bad debts of 1.2 million, depreciation of 8.6 million, rent of premises of 11 million. Then we have advertisement of 1.5 million. Then we have motor expenses of 400,000 naira. We have printing and stationery of 870,000. We have donations of 340,000. We have allowance for doubtful debts of 670,000. We have audit fees of 2.3 million. We have bank charges of 1,672,000. We have legal fees of 1.3 million. We have transport and traveling of 1.2 million. The total expenses is 60,252,000. Then we have profit of 7,748,000. That is profit before profit on sale of car. Then we have profit of sale of car of 6.8 million. We have profit for the year of 14,548,000 naira. Additional information provided is as follows. 1. Machinery purchase in 2020 with a tax written down value of 1,050,000 naira was sold for 2.5 million naira during the year. The capital allowances claimed on the machinery up to time of sale was 1.6 million naira. 2. Repairs and maintenance comprised motor vehicle purchase of 7 million naira, then repairs on building of 3.2 million naira, repairs on machinery of 2.8 million, total 30 million naira. Donations were made as follows. The Boy Brigade of 140,000 naira. Then we have Sani Social Club of 200,000 naira. Then total is 340,000 naira. Then we have legal fees comprise retainership of 800,000 naira, court fines of 500,000 naira, total 1.3 million naira. Bad debts included the sum of 280,000 naira as general provision. Salaries include a 350,000 naira paid to the private domestic servant of the chief executive officer. Additional capital expenditure incurred in January 2023 included plant and machinery of 2.4 million, buildings 2,250,000 naira, furniture and fittings 1.5 million, motor vehicles of 8.5 million. The company's turnover for the period was 150 million naira. Required. 1. Compute adjusted profit of Zarin Limited. 2. Compute the income tax liabilities of Zarin Limited for the relevant year of assessment. From the requirement 1, we are to compute the adjusted profit of Zarin Limited. The name of the entity is Zarin Limited. So we have Zarin or Zarin Limited. So computation of adjusted profit. For we don't put year ended. There is nothing like year ended in taxation. Taxation is usually computed unless you want to have it as a working. You can only have year ended where it is a working. It is not part of, it is not the amount of profit that will be assessed in that particular year of assessment. So for instance, if the accounting period is more than a year, that means that profit will not be met or will not be due for assessment for 1 year. So especially during commencement of business or during change in accounting date, where the accounting period may be prepared for more than 12 months. So that means the profit of over 12 months will not relate to one particular year of assessment. So you can compute it for the year ended before you now apply the relevant tax provisions in order to carve out the amount of profit that will be that will be due for assessment in a particular year of assessment. So it is always essential you put year of assessment, especially where you have a question. Examiner might say for relevant year of assessment, you must put the year of assessment. Where you are expected to put the year of assessment, failure to put the year of assessment in your question will amount to 0 marks. So now, what will be the year of assessment for Zarin Limited? So remember the profit you are given here. The profit, the audited financial statements for the year ended December 31st, 2023. So this is profit for the year ended 2023. No, you were told the business commenced in November 2019. The profit you are given is not from 2019 to 2023. You were only told the business commenced. You were given the year the business started. But the profit you are given, the audited financial statement for the year ended. That means the financial statement prepared is for the 2023 accounting year. So the profit you are given is for 2023. So you have, and remember, PYB, preceding year basis, is used for an ongoing business. This is an existing business. Preceding year basis should be used. So the profit for 2023 will be assessed in 2024. So you now put for 2024 year of assessment. Another word for year of assessment is tax year. So if you don't put the year of assessment, you may use tax year. So we have naira and triple zeros. Now, as a rule, as our normal rule, we used to start with the accounting profit. That is the profit before tax. Besides, the profit you are given in the question, no tax has been charged. You were not given the amount of tax charged, so you only have profit for the year 14,548. So you start with that profit, then before you adjust for non-allowable expenses. So let me tell you, some of you were saying that the video I have is no longer correct. So for example, the video I have on commencement rule is based on Finance Act 2019, and no other principle, no other tax law has changed the commencement rule. So it means all the videos I have on my channel is still very useful. So in fact, the major changes we have does not impacted my existing videos. So adjusted profit, the principle is still the same. The non-allowable expenses remain as it was in that video. So it means the video I have on adjusted profit on commencement, on change in accounting day, on cessation, even the capital allowance computation, all the videos I have on my YouTube channel are current. So you can use them. So they are still reliable. So we have net profit as per account. Net profit as per account. And that amounted to 14,548. Then we now add back non-allowable expenses, or you add back disallowable expenses. Now, let's first of all go through the phase of the statement of profit or loss. Statement of profit or loss, and try to find out if there are any expenses that are not incurred wholly, reasonably, exclusively, and necessarily for the purpose of revenue generation. So for better understanding, I will advise you watch my earlier video on adjusted profit computation, and my capital allowance video will equally help you to understand the aspect that relates to capital allowance in this question. So now salaries, disallowable, repairs and maintenance. I'm not reading the additional information. There might be some notes that might require you to disallow some of the salaries. So I'm ignoring everything in the note for now. I want to see what I can identify of the phase of profit or loss that are not allowable. Repairs and maintenance, bad debts is allowable, repairs and maintenance is allowable, depreciation is not allowable. So we will add back our depreciation. So we have depreciation. Depreciation amounted to 8.6 million. 8.6 million naira. Now, back to the statement of profit or loss. Rent of premises is allowable. Advertisement is allowable. Then motor expenses is allowable. Printing and stationery is allowable. Donations is some donations are allowable. Donation given to approved body is allowable. So if it is not allowable, by the time we get to note, we will know the portion that is not allowable. Allowance for doubtful debts. If the question is silent about the allowance for doubtful debts, if no note is given as to this, we assume it is general provisions for bad debts or general allowance for doubtful debts. and general provision is not allowable. So if there is no note relating to this, that means it is not allowable. But let's leave that for now. We have all these fees is allowable. Bank charges is allowable. Legal fees subject to condition. It depends on the reason or why this legal fees was incurred for. So we cannot say anything for now until we get to note. Transport and traveling is allowable. Profit on sale of car is not a taxable income. We're supposed to deduct this because it is not taxable. Profit from sales of non-current asset. Car is a tangible non-current asset. So it's not allowable. It's an accrual concept. It follows accrual principle. No taxation follows cash principle. So profit from sale of asset is not allowable. So we will subtract that. But we are still dealing with those items to be added first. Additional information provided is as follows. Machinery purchased in 2020 with a tax written down value of 1,050,000 was sold for this. This is giving rise to a balancing charge because the sales proceed of 1,050,000 is greater than the sales proceed of 2.5 million is greater than the tax written down value of 1,050,000. So that means the difference will represent the balancing charge. So the balancing charge will be added after the adjusted profit. The capital allowances claimed on the machinery up to the time of sale was 1.6 million. So the reason for giving you the capital allowance is that they want you to know if you add this capital allowance plus tax written down value, you'll be having 2,650,000, which is greater than the proceed. The essence of this is to know whether it will lead to a balancing difference. So if the cost of acquisition, the cost of acquisition is 2,650,000. If you add the tax written down value at the capital allowance, the cost at the time of acquisition is 2,650,000, which is greater than the sales proceed. If the sales proceed is greater than the cost at the time of acquisition, that means the difference will be balancing difference. And balancing difference does not have tax. It doesn't have tax implication. It should be ignored. We don't use balancing difference in accounts. So that is the reason why they've given you the capital allowance, so as to know if the difference will be a balancing charge or balancing difference. No, we have balancing allowance too. Where the tax written down value is greater than the sales proceed, you have the balancing allowance. But since the sales proceed is greater than the tax written down value, you have balancing charge. But if the cost at the time of acquisition is greater than the sales proceed, then that means you have the balancing. If the sales proceed is greater than the cost at the time of acquisition, that means you'll be having a balancing difference. We don't use to recognize balancing difference. We don't use to record it in tax. So please bear that in mind. Then we have repairs and maintenance comprised. The first item there is motor vehicle purchased. Motor vehicle purchase is a capital expenditure. This is a capital expenditure. Capital expenditure is not allowable for tax purpose, so we are going to add it back. It's not allowable. Repairs on building is allowable. It's a revenue expenditure. Repairs on machinery is allowable. So the only one that is not allowable is the 7 million. Repairs and maintenance. It's a motor vehicle purchase. We said that one is a capital expenditure. It's not allowable. That is why we are adding it back. The next note is donation. Donation was made as follows. The Boys Brigade, 140,000. This is one of the approved body in which donation can be made. So donation made to Boys Brigade is allowable. Then Sani Social Club is not allowable. It's not among the list of the approved body. So if you want to go through the list of the approved body in which donations can be made, you can go through the advanced tax study test under adjusted profit. You have or check out the list of the approved body upon which donations can be made. We have Sani Social Club, 200,000. Donations to Sani Sunny Social Club. And that amounted to 200,000. And then after that, we have legal fees comprised. The first item you have there is retainership, 800,000. That is allowable. Court fines. No one asks you to breach the law. So before the court will fine you, that means you have breached some laws. So as a result of that, this is not allowable. So we have legal fees. Legal fees. That is court fines. And that amounted to 500,000 naira. Then we have bad debts. That is the next note. Bad debts included the sum of 280,000 as general provision. So you were told, a general provision for bad debts is not allowable. So bad debts, that is general provision of 280,000 naira. You were told salaries include a 350,000 naira paid to private domestic servant of the chief executive officer. So private, it's a private expenditure, not allowable. Salaries to domestic servant. Domestic servant. And that amounted to 350,000 naira. Then the next note is a note on capital expenditure. You were told that capital expenditure incurred in January 2023 included plant and machinery, buildings, furniture, and fittings, motor vehicles. All this expenditure will be used in computing the capital allowance. The company's turnover for the period was 150 million. This turnover of 150 million is given to show that this company is a large company. The rate to use depends on the size of the company. A company with annual turnover of less than or equal to 25 million is a small company. And the tax rate for small company is 0%. And a company with annual turnover of greater than 25 million but less than 100 million is a medium-sized company. And the tax rate for a medium-sized company is 20%. And for a company with annual turnover of 100 million and above, that is a large company. And the tax rate for a large company is 30%. So this 150 million is above 100 million. So that shows that this company is a large company. So the rate of tax to use for this company will be 30%. That is the essence of the turnover you are given here in order to know the size of company. So because the size of company determines the rate to use in computing the tax liability. We didn't have any note on allowance for doubtful debts of 670,000. And I've told you that where there are no notes about that, so you know that it is general allowance for doubtful debts. And general allowance for doubtful debts is not allowable. So, if it is specific, you'll be told in the question. If the question didn't tell you that the allowance is a specific allowance for doubtful debts, specific is allowable. But if it is not stated in the question as specific, it is general. And general allowance for doubtful debts is not allowable. So we have allowance for doubtful debts. And that amounted to 670,000. After all these items, so what would be the sum of our non-allowable expenses? So now let's sum up everything. So we have 8,600 plus 7,000 plus 200 plus 500 plus 280 plus 350 plus 670. That is totaled 17,600. 17,600. If you add that to 14,548, so we have 32,148. Then remember we have profit on sale of car. I've told you that profit on sale of car is not taxable. So we will need to deduct the profit from sale of car. We have profit from sale of car of 6.8 million. I've told you it followed accrual basis and it's not taxable. Since it is not taxable, we are going to deduct that profit. So less non-taxable income, and that include profit from sale of car of 6.8 million. So if you subtract 6.8 million from 32,148,000, we have 25,348,000. 25,348,000. That is our adjusted profit. This is the end of the solution to Roman figure 1. Now let's take the Roman figure 2. In number 2, you have to compute the income tax liabilities of Zeri Limited for the relevant year of assessment. Remember, I've told you that you should not put relevant year of assessment. Always state the year of assessment. 2, the name of the entity is Zeri Limited. So in 2, you have to compute the income tax liability. So we have computation of income tax liabilities the question put for relevant years of assessment or for relevant year of assessment. So you have to state the year of assessment for since the financial statement was prepared for the year ended 2023. So since it is 2023, so on PYB, the year of assessment will be 2024. For 2024 year of assessment. From our computation, we have assessable profit, which is the same as our adjusted profit. Assessable profit or adjusted profit. The result obtained from working one from requirement A, we have an adjusted profit of 25,348,000. So we have 25,348. 25,348. So loss relief. There is no loss relief in the question. So we have balancing charge. Balancing charge. You were told a machine with tax incident value of 1,50,000 were sold for 2.5 million. 2.5 million minus 1,50,000. So you have the difference of 1 million, 2.5 million minus 1,50,000. Then you have balancing charge of 1,450,000. If you add it to the assessable profit of 25,348, so we have 26,798,000. Then after this, we have capital allowance for the year. Capital allowance for the year. So, if you have capital allowance brought forward from the prior period, brought forward, in case you have any. So, the capital expenditure given in the question will be used to compute the capital allowance. Let's have that as a working number one. So, computation of capital allowance for 2024 year of assessment. We only want to compute the capital allowance for 2024 that will be claimed from our profit to get the total profit upon which tax computation will be based. The capital expenditure we have include plant and machinery, buildings, furniture and fittings, motor vehicles. So 1, 2, 3, 4. We have 4 capital expenditure that qualifies. So let's do 5 columns. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. The first one is plant and machinery. The second one is building. The third one is furniture and fittings. The fourth one is motor vehicles. Then let's have capital allowance for the year. Now, we want to use the appropriate capital allowance rate. Mind you, the capital allowance rate will be given in your question paper. The relevant rate will be given towards the last page of your question paper. So we have initial allowance, we have annual allowance, we have investment allowance. Initial allowance 50% on plant and machinery, annual allowance is 25%, investment allowance is 10%. I will decide whether we will need to use the investment allowance or not. So this one is 15%, then we have 10% as annual allowance. This is 25%, we have annual allowance of 20%. Then we have 50% of motor vehicles, annual allowance of 25%. Then, our computation is for 2024 year of assessment. What is the basis period for 2024 year of assessment? The year ended for the business is December 31st. So if you have 2024 year of assessment, basis period, so we have 2024. Since the year ended is 31st of December, that means the basis period will be from 1st of January 2023 to 31st of December 2023. So, and if you look at the capital expenditure given in the question, you were told they were acquired on the 1st of January 2023. January 2023 is part of 2024 year of assessment. Since you can align the date of acquisition with this 2024 basis period, that is to show that all capital expenditure acquired in this basis period all qualifies in 2024 year of assessment. According to financial 2023, up to 31st of August 2023, we still have investment allowance on plant and machinery at the rate of 10%. But effective from September 1st, 2023, investment allowance have been removed by Finance Act 2023. This expenditure were incurred on January 2023, which is a period prior to August 31st, 2023. That means we will still need to include the investment allowance since January 2023 came before 31st of August 2023. It means if it were still acquired from January 2023 to August 2023, you will still need to include the investment allowance. But if acquisition date is from September 2023 to date, then till date, that means no investment allowance is required. Therefore, we are going to include the investment allowance on plant and machinery at the rate of 10% of cost. So we have 10% for investment allowance. So amount in thousand. So the capital expenditure incurred on January 2023, we have plant and machinery of 2.4 million, building of 2,250,000, furniture and fittings of 1.5 million, motor vehicles of 8.5 million. So those are the qualified capital expenditure we have in 2024 year of assessment. So plant and machinery 2.4 million, then building of 2,250,000. Then we also have furniture and fittings of 1.5 million. Then motor vehicles. So we have motor vehicles of 8.5 million. So remember motor vehicle, let me have that as working. Working too, motor vehicles. The one acquired as of 1st of January 2023. We have the cost of that to be 8.5 million naira. Remember, we have capital expenditure on motor vehicle, which was treated as non-allowable expenses. We have repairs and maintenance, motor vehicle purchase, 7 million. That is a capital expenditure. That is why it was disallowed. Since it was disallowed, then it will be treated as part of qualified capital expenditure since it was just acquired during the year. So we have acquisition during the year. Acquisition during the year. We have 7 million. That means the cost of motor vehicle will be 15.5 million naira. So that is the amount that will be treated as the qualifying capital expenditure on motor vehicle for 2024 year of assessment. We have motor vehicle of 15.5 million. So we have initial allowance. Initial allowance is usually calculated on cost. Just apply the rate on the cost. 50% of 2.4 million, that will be 1.2 million. Then 15% of 2,250,000. That gives us 337.5. This is 337.5. 337,500. 25% of 1,500. That gives us 375,000. Then 50% of 15,500. That gives us 7,750. If you sum up our initial allowances, 7,750 plus 375 plus 337.5 plus 1,200. The initial allowance is total 9,662.5. Let me reconfirm the cost. 1,200 plus 337.5 plus 375 plus 7750. That gives us 9,662.5. The annual allowance. Annual allowance is usually calculated on the residue of qualifying capital expenditure after deducting the initial allowance. So the residue is cost minus initial allowance. And then how many years will plant and machinery last? Annual allowance rate is 25%. So just divide the annual 100 by annual allowance rate. How many years? Plant and machinery now. Plant and machinery, the number of life. So we have 100 divided by annual allowance rate, which is 25%. That gives us 4 years. It means plant and machinery will last for 4 years. So annual allowance now on plant and machinery will be cost. The cost of plant and machinery is 2.4 million minus initial allowance of 1.2. So 2.4 minus 1.2 million divided by 4 years. So that gives us 300,000. 300,000. That is the annual allowance on plant and machinery. So you don't need to prorate it since we have up to 12 months in 2024 basis period. 2024 basis period is a period of 12 months, that is from January 2023 to December 31st, 2023. Since you have up to 12 months, that means the annual allowance is claimable in full, 300,000. Then for building, the annual allowance rate is 10%. So we want to compute the annual allowance on building. So we have 100 divided by annual allowance rate, which is 10%. That will give us 10 years. That means building is expected to last for 10 years. So to compute the annual allowance on building, you have the cost minus initial allowance. Cost minus initial allowance, which is 2,250,000 minus initial allowance 337.5 divided by, I'm adding K because the amount are in thousand. I'm not writing them in full. That is why I'm adding K to it. I can add K to this. Divided by how many years? 10 years. That gives us 191.25. That is 191,250. 191,250. That is the annual allowance on building. 191,250. So then we also have furniture and fittings. Furniture and fittings. So the annual allowance rate of furniture and fittings is 20%. Furniture and fittings. How many years? That will be 100 over 20. Since the annual allowance rate is 20%, that will be 5 years. So to compute the annual allowance on furniture and fittings, you have cost minus initial allowance of 375. So cost 1.5 million minus initial allowance of 375,000 divided by 5 years. That will be 225,000. 225 That is the annual allowance on furniture and fittings, 225,000. Then after furniture and fittings, the next one is motor vehicle. And the motor vehicle, it have a annual allowance rate of 25%. Motor vehicle. Since the annual allowance rate is 25%, that means 100 over 25. Motor vehicle will last for 4 years. So annual allowance will be cost 15.5 million minus initial allowance of 7,750,000 divided by how many years? 4 years. This will give us 1,937,500. 1,937,500. That is the, 1,937,500. That is the annual allowance on motor vehicle. So after that, 1,937,500. So let's sum up the annual allowances. Plus 225 plus 191.25 plus 300. The annual allowance is total 2,653.75. That is the annual allowance for the year. If you sum up the annual allowances, the annual allowance and the initial allowance, rather, 9,662.5. Then we have the total of 12,316.25. Now, we have investment allowance. Investment allowance. The rate of 10% on cost, 10% of 2.4 million. 10% of 2.4 million, that gives us 240,000. So we have the investment allowance of 240,000. If you add it to 12,316.25, then we have 12,556.25. This is the capital allowance for the year. Capital allowance for the year. After the capital allowance for the year, so we now have the tax written down value or the qualifying capital expenditure, which will be brought forward to 2025 year of assessment. So 2,400 minus 1,200 minus 300, that gives us 900 for this one. 2,250 minus 337.5 minus 191.25. This one gives us 1,721.25. 1,500 minus 375 minus 225. This one gives us 900. Then 15,500 minus 7750 minus 1937.5. This one gives us 5,812.5. This is the tax written down value, which will be brought forward to 2025 year of assessment. Having computed the capital allowance for the year to be 12,556,250. So we can claim our capital allowance for 2024 year of assessment. So the capital allowance for the year from our computation is 12,556,025. There is no capital allowance brought forward from previous year, so that means our capital allowance will still remain the same. How much will be claimed as capital allowance for the year? So we have capital allowance claimed, allowance claimed. The capital allowance claimable in any year of assessment must not exceed 2/3 of the assessable profit. If you calculate 2/3 of this, 2/3 of this, let's confirm that 25,348 times 2 divided by 3, that is 25,348 times 2 divided by 3, that gives us 16,898.66. You see that it's greater than this. 2/3 of this is greater than this. That means you can claim all the capital allowance. You can utilize it in that period. But if this one is greater than 2/3 of this, that means amount that will be claimed must not exceed the 2/3 of this. So we restrict it to 2/3 of it, then the remaining ones will be carried forward to the next year of assessment. But 2/3 is greater than the capital allowance we have. That means we can claim all the capital allowance. We can utilize it in that year. So we have 12,556.25. 12,556.25. So how much will be carried forward as capital allowance? We don't have any capital allowance to carry forward. That means capital allowance carried forward will be nil. So if you now if you claim the capital allowance from the profit, so the profit we have is 26,798 minus the capital allowance of 12,556.25. So we have 14,241.75. That is the total profit. Total profit. So the total profit now, we will now compute our tax liability. I've told you that the tax rates depends on the size of the company, whether it is a small company or a medium-sized company or a large company. If you look at the turnover, you are given turnover. You were told the company's turnover for the period was 150 million. So the 150 million exceeds 100 million. That shows that this company is a large company. And for a large company, the tax rate is 30%. So 30% will be used as our tax rate. You have to compute the income tax liability. So company income tax liability, income tax liability at 30%. So what is 30% of this? That is 4,272. 4,272.525. That is 4,272,525. That is the company income tax. Then tertiary education tax. Tertiary education tax at 3% of assessable profit. 3% of assessable profit. How much is our assessable profit? Assessable profit of 25,348,000. 25,348,000. What is 3% of that? 3% of 25,348,000. So that gives us 760,440. So we have 760,440. So that is the end of the solution to the question. But some of you believe that the tertiary education tax of 3% has been replaced by development levy of 4% of assessable profit. Yes, that is true. But effective from January 2026. January 2026, the year of assessment you have in question is still 2024. It will be wrong for you to use development levy of 4% when the year of assessment is 2024. And the development levy of 4% is becoming effective from January 2026. And I've also told you that the investment allowance on plant and machinery, so we said it was included because it was bought on 1st of January 2023. And it is from September 1st, 2023 that the Finance Act 2023 removes the investment allowance. Please bear all this in mind. Thank you. Please drop the love emoji, like the video, and also share it with others if you find this video useful. Thanks for watching ACCA.